All right, I'm joined now by financial expert Chuck Zodda from the Armstrong Advisory Group. We're just a few days into June, but May was a huge rebound month for the stock market. What do you see happening as we head toward the third quarter of 2025?
Well, I think we're heading towards a pretty critical juncture in that we're going to see whether or not these tariffs start to actually bite at the US economy over kind of that June, July, August period. Because pretty much what we've seen is that, look, in April, most companies were still working off pre-tariff inventory. That was still even the case into the first part of May. We're now at a point where if you had stuff that you had to import from overseas, it is going to be coming through with those additional costs. And so, how does that impact margins? How does it impact demand if you have to raise pricing? These are all things that we're now going to be navigating. And so, I think it's going to be very interesting to see exactly how this shows up in the economic data over the next few months. And I think we're approaching a turning point where we're either going to see, hey, this is causing a real drag on the US economy, or hey, there's no major impact and we can kind of continue on with our regularly scheduled programming.
Obviously one of the big talkers right now is the Trump administration's big beautiful bill, and there's reports saying it could add trillions to the national deficit. What could this mean for the economy and even the bond market?
Well, I think the big thing is I'll take the second part of that first, actually. With the bond market, if you have more borrowing, it's more supply of bonds. And so it does raise the question as to, hey, what is the demand for those going to be? Are you going to have buyers at current pricing, or do yields have to go up, which potentially pushes up the cost of borrowing for average Americans through higher mortgage rates, car loans, things along those lines? When it comes to looking at the economic impact, most of this is coming in the form of simply extending the current tax rates out. So it's unclear how this, creates any additional demand in the U.S. economy. But I think it also raises a question: hey, if there are places where it does create demand, if you have tariffs that are in place that are potentially raising costs at the same time that you have more demand, does that prompt a new wave of inflation as well? And that's something that I think is worth watching as a possibility as we go through the next, 6 to 9 months here too.
And the president has he's made it clear that he wants interest rates lowered. I mean, do you see that happening? Should it happen?
Well, so the Federal Reserve operates with a dual mandate to maintain maximum employment and price stability. And so the way that you typically see interest rates being cut is if the employment part of that mandate is threatened. Today, we still have unemployment at 4.2%, but we are seeing some signs that the labor market may be slowing. I don't know that it's slowing enough for the Fed to be cutting now, but normally, if you were to see that accelerate and become a worsening problem, the Fed might start to cut over the next 3 to 5 months. I think the question here is, with these tariffs in place, if you have unemployment going up at the same time that inflation may be going up, it puts the Fed in a tough spot. And basically, what Jay Powell, the Fed chair, has said is we're going to have to base this on where the greater threat is if we do see both inflation and unemployment rising. So if unemployment is rising faster, maybe the Fed starts to cut then. If inflation's rising faster, the Fed may decide to do nothing or even hike rates depending on, the magnitude of the differences. So I think we're in a very dynamic period right now with a wide range of policy outcomes here.
Speaking of the inflation report, there was also a report in the Wall Street Journal saying the Bureau of Labor Statistics was forced to cut back on the number of businesses where it checks prices because of a hiring freeze. That's kind of raising questions about the accuracy of the inflation report. What do you make of this and the effect it could have on the economy and Wall Street?
Well, it's not great news in terms of the accuracy of the data, and I think that this is something that is often underappreciated today, simply because I think we take for granted that the economic data that comes out is of a certain quality, and if that quality degrades and it's no longer a meaningful signal, then you start to wonder, hey, am I getting an accurate read on what inflation is in the country? And the implication then is, okay, if I don't know exactly what it is, do I have to build in a little bit more of a premium for inflation in borrowing costs? And does that act of not knowing what inflation is end up raising borrowing costs for the US or for individuals inside the US simply because people don't necessarily have as good of a handle on inflation and need to get some additional compensation because of the risk that inflation runs hotter than people than we're measuring it. So I think this is kind of an underappreciated, it's a little bit of an inside baseball technical thing, but I do think the quality of economic data is something that we can't take for granted, because if that quality goes down, it represents a real problem in trying to understand how the economy is actually behaving.
Right, all those building blocks begin to fall. All right, well, Chuck Zodda from the Armstrong Advisory Group, thank you so much, as always, for joining us.
All right. Have a great day.